Hello everyone, I've just prepared a short voiceover PowerPoint on the area that most people seem to have the most trouble with their financial plan for their business plan, and that is the end of year balancing. So we'll run through what we're actually trying to balance and then how you might go about it and what to do if you have a few problems. So what are we trying to balance? We know that the accounting equation is owner's equity equals assets minus liabilities. So what the owner actually owns, their net assets, it's also called, is the sum total of everything they own minus what they owe to somebody else. It's like the exit figure. If you were to sell up and go somewhere else, what would you have left over in cash? So what we're trying to do when we balance is to make sure that year on year all of the numbers have been placed in the right spot. And this is one of the unique things about double entry accounting. It has this self-balancing ability. So balancing in our first year is really easy. We just do that equation, assets minus liabilities. But as we move on, it becomes a little bit more complicated because we have to take into account the changes which have occurred through the year. So basically, to work out our closing owner's equity, so from the end of the first year, we have our opening owner's equity from the beginning of the year, we add our profit or we deduct our loss, we take away the drawings that the business owners would have taken. If it's a company, that will be dividends. We add or deduct revaluations that have been made to things like land. Most of the depreciation is caught up in another part of the transaction. I'll talk about that later. And we take away tax. Now you may see this equation listed a little bit differently if the net profit figure has been used. So if it's net profit, the tax has already been deducted. If we're looking at our gross operating profit, the tax hasn't been taken off, so we do need to add that on the end. So this has to balance with the end of year net assets. So what does this look like? This is what we're aiming for. We put or calculate our current assets, non-current assets and our liabilities through here. We do the equation, net assets or owner's equity equals total assets minus the liabilities, and we come to this $2.9 million figure here. Then we have to reconcile it to make sure that it's accurate. So we look at our opening balance for the year, we add the net profit, we add the asset revaluation here. So what's happened here is land has increased by $50,000, and you can see that there. The opening balance would have been $3 million. The asset value has been increased by $50,000, and we add that in there. We take off the drawings that the business owners have taken for their living expenses, and we end up with the closing balance figure there, and that actually balances to our calculated net assets figure. We have a check cell built in here, and we know those two figures are equal, and it says true. Now we delete that before submission, but it's just nice to put it there as we go through and see the true, 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 and know that it's actually balanced without really having to go to the trouble of reading each individual number down to the last digit, because in all likelihood you're going to have a lot of these ones, tens and hundreds figures put in there, and those figures are going to be more difficult to read. Now I mentioned earlier we have our revaluations here in a revaluation reserve for our land, and in your business plan that's possibly the only revaluation you have. I wouldn't suggest you be revaluing anything like plant and machinery or the fixed improvements over the term of the 5 years. So your plant and machinery will depreciate over that period of time, but that depreciation will reduce your profit figure, and that's how it will be encapsulated in that part of the equation there. So no upward revaluations of plant and machinery or fixed improvements over the term of your plan, just to simplify things. So in double entry accounting, just remember that each transaction affects the accounts in two ways. So revaluations increase the asset value and increase asset revaluation reserve. We saw that there with the land. Machinery purchases increase asset value and decrease cash. So over here, if in the next year you buy $50,000 worth of new machinery, that will increase the asset balance there, but it'll also reduce the bank account balance. Sales generating profit increase cash and also increase profit in the reconciliation, and a new loan increases cash and increases liabilities. So if we have a look back to our transaction, you can see how something will affect, either cancel out within one part of the transaction, or will affect the owner's equity and the assets or liabilities in the other side of the transaction. So just to run through for a couple of different organisational or business structures, in a partnership, we may also have something further to complicate it. If the business owners have made a capital contribution, perhaps they've sold some shares and put those into the business, or had some savings from elsewhere that they're looking to grow the business, or perhaps they've had a new partner into the business and that partner's come with a capital contribution to buy their way into the business. Effectively, that would be shown up there. If we have net profit included there, any drawings the business owners take, and the net asset revaluations there. Company, much the same, just a little bit of a difference in terms of terminology. We talk about shareholders' equity. The increase in shareholders' equity if capital is introduced is called the share capital raised by share issue. You're unlikely to have that in the businesses that you're dealing with. Net profit, dividends paid, so that's the equivalent of drawings for a company structure. Any asset revaluations, and then the shareholders' equity at the end of the year. For a family trust, for those of you who are working with a business that operates as a family trust, we talk about beneficiaries' equity. We add net profit, or we take away the loss. We talk about distributions rather than drawings or dividends. So in a family trust, the way that profits are distributed from that business, it's called a distribution. We plus or minus asset revaluations, and then we have beneficiaries' equity at the end of the year. So you'll recall from earlier studies that the closing statement of financial position should automatically balance, providing transactions which occurred during the year have been properly accounted for. It should happen automatically, theoretically. If it doesn't, some errors occurred in the financial analysis, and you'll need to check each and every component of the analysis to find the error. However, there are some areas to have a look at first. If it doesn't balance, look at tax first. Make sure you haven't confused income tax with GST. Make sure you haven't included net profit and then taken the tax off again. Look at the revaluations of land and also look at your livestock accounts. Make sure that you've got them correctly allocated to current and non-current assets and that they are properly accounted for. Make sure your drawings are correctly allocated if included, and there's no confusion between drawings and wages. Remember that a company will pay its employees, if they are the business owners, a wage. If it is a sole trader or a partnership structure, this payment in lieu of services rendered is called a drawings. So a partnership can't actually legally employ, a partnership or a sole trader can't legally employ the business owner. So that's basically where you need to look to first. Set up a check cell with the above equation. Net assets for the end of the period equals owner's equity. The answer should be 0 or true. Remove this prior to submission. It's like your working notes, and good luck with your balancing.